Meantime, our next guest says the stock market may be bottoming, but still expects it to be choppy through the middle of the year. Joining us this morning is Ed Yardeni, Yardeni Research President. Ed, always good to have you. Thanks for joining us this morning.
Thank you, Carl.
The recent note of yours that caught my eye, at least, is when people were beginning to say, okay, maybe the worst of the correction's out of the way, but it sounds like your eyes are still on April 2.
Yeah, it doesn't have to be a V-shaped recovery from the correction. It could be a continuation of the choppiness. We thought at the beginning of the year that it could be a choppy first half of the year as we're all trying to get a handle on what Trump 2.0 policies are all about. And right now it seems to be more about chaos than anything that we can get a clear signal on. Kind of the noise to signal ratio is extremely high. And we're going to get a lot more noise on April 2nd. We'll see what these reciprocal tariffs actually look like. Apparently, they're going to be targeted at the dirty 15, the countries that we have deficits with. And then let's see how the dirty 15 respond. You know, in that movie, what is it, the Dirty Seven? They responded pretty aggressively to the challengers. And so it's conceivable that instead of having reciprocal tariffs that are negotiated down, there'll be some retaliation going on from the other side. So it's a mess.
Right. Goldman has a survey out today where respondents think the reciprocal tariff rate could be somewhere in the neighborhood of 9. Goldman itself thinks it could be actually maybe twice that. Do you have a view either way?
Yes, I do. They're both right. I mean, look, tell me what Trump is going to say that morning. I mean, he could say that his advisors gave him the higher number, and he decided to half it just because he wants to negotiate. But it's not even clear that he wants to negotiate. He has contradictory objectives with these tariffs. He wants to bring their tariffs down, but he wants to keep our tariffs up in order to raise revenues and to bring manufacturing back. So again, it's all very confusing, and I think the market's going to continue to be choppy on all that. I know yesterday and on Friday the market was up because Trump said that there might be some flexibility and that they may be more limited in terms of the tariffs. But we're still talking about tariffs and a lot of uncertainty about the reaction of other countries to that.
What do you make of the firming bond yields? We know that the administration wants to see lower bond yields, and they've been acting on that front. Yeah. And now there's worry. I highlighted prices paid that we got in the S&P Global. There are indications of price, at least stubbornness, when it comes to inflation coming down. Is that a big risk for the market?
Well, we've been anticipating that the 10-year bond yield would kind of hover in a range between around 4.5% plus minus 25 basis points, so 4.25% to 4.75%. So we're really not surprised by that. But one of the areas of success so far with Trump 2.0 is he has stimulated the Chinese government to stimulate their consumers. And so bond yields have started to go up there. They were like down approaching zero, but they've rebounded in China. And then, of course, in Europe, the Germans have passed measures to spend a lot more and stimulate their economy. So their bond yields have gone up. And the bond market's a global bond market. And we're seeing that having an upward impact on our bonds.